Now you may be asking, what is downside risk? According to Investopedia, downside risk is an estimation of a security's potential to suffer a decline in value if the market conditions change, or the amount of loss that could be sustained in a result of the decline. Depending on the measure used, downside risk explains a worst-case scenario for an investment or indicates how much the investor stands to lose. Yes, that sounds really boring. So in layman's terms, downside risk is how much money you can lose if all hell breaks loose with your investment, or if the market just drops out from under you. You may be asking why I'm in a suit. It's because I did a fancy video about my refinance that you should have seen last week. So if you didn't, go watch it. Now, it's way too easy to get caught focusing on the upside potential of an investment as opposed to worrying about the downside risk. The upside is much sexier and more fun to think about. Think about it, which sounds better? You could triple your money in a month, or you can manage your losses to ensure you don't lose more than 2% this month. Granted, my tone of voice probably tells you which one I wanted you to think sounds sexier, but obviously tripling your money is much more exciting and feels much better. But which is more important? Ironically, the most successful investors are those capable of managing their downside risk. It's much faster, easier, and more detrimental to lose money than it is to win big on an investment. For example, a 50% loss requires a 100% gain to break even. So take a look at this chart. If you have $100 and you take a 50% hit one month, it leaves you with $50. If you then receive a 50% return on investment, ROI, the following month, it will only bring your investment back up to $75. In the next month, you would need just under a 34% return on your investment to return to the original value. In order to regain the value of your investment after a 50% loss, you would require a 100% ROI on what is left. Now, stated another way, if you lose 50% of your investment portfolio, your money must double, 100% return, in order for you to break even. Whereas it only takes a 33% loss to erase a 50% gain. The previous scenario wouldn't be so bad if the numbers worked both ways, but they don't. Just look at this next chart. After you smash that like button, if you have $100 and you get a 50% ROI one month, it leaves you with $150. Not bad. However, if you then take a 50% the following month, it will bring your investment down to $75. In fact, it would only require a 33% hit in order for your investment to return to the original value. So it only takes a 33% hit to plummet back to the original value of your investment after it took a 50% gain to get there. Stated another way, if your portfolio jumps to 1.5 times its original value, it only needs to drop by 1/3 in value for you to be back where you started. So hopefully these charts helped make this concept easy for you to grasp, but long story short, your portfolio will drop in value much faster than it will grow with equal market gains and losses. So we're going to talk about protecting your downside risk in real estate. Luckily, there are many ways to mitigate your downside risk as a real estate investor. Even better, most of these are really simple and inexpensive things to do, which is one of the reasons I love real estate investing. So the first thing you need to do is get educated. Ignorance is not an excuse when things don't go your way with real estate. So take the time to learn some more, and continue learning throughout the duration of your life. The more you understand tax codes, landlord laws, financing pros and cons, and all aspects of real estate, the more you will be able to foresee potential issues and stop them from biting you in the rear. The most important things for you to be educated on at the beginning, in my opinion, are analysis, due diligence, which has its own section below, and operations. You need to understand analysis completely. If you miss a single expenditure or account for more income than the property is generating, you could easily find yourself paying out of pocket to hold on to your investment. If you don't understand operations and budgeting for operations, investing can be a really bumpy road. And if you aren't willing to educate yourself on operations, just do yourself a favor and hire a property manager. I have a really awesome video on questions that you need to ask property managers during the interview, so check that out. Never stop learning, bottom line. Number 2 is insurance. This is a no-brainer. You need to insure your real estate investments, just as you would a car, primary residence, valuables, or anything else that's worth insuring. You can even insure your legs, voice, or mustache. Merv Hughes just became my hero for this. The great thing about insurance is that almost any outside factors damaging your property will be covered. That is a great way to protect your downside. There are even insurance policies that will provide insurance for rental income. If your property sits vacant for too long, you could receive money from the insurance company. Now, talk about protecting your downside, although I believe this is an unnecessary expense if you run your property correctly. Just make sure you insure yourself against the what ifs of real estate, and you'll be glad you did. Insurance has saved me a couple $1,000s over the last few years for just random issues. Next, you need to make sure you do due diligence. Now, due diligence is the make or break in purchasing real estate. You need to understand what you're looking for in order to ensure there aren't a ton of underlying issues with the property you have under contract. Within the due diligence process, you need to understand how to verify every single item on the income and expense report and find items that may have been omitted. Utilize your due diligence period to the max. This is your chance to pull chocks if there are issues with the property. If you discover issues with the property during inspection, you can ask the seller to fix them, give you that money at closing, which is my preference, or reduce the cost of the property. Now, I like to have my property manager walk through the property as well and have them bring estoppel agreements or whatever their own method is in order to verify that what the tenants claim to be paying for rent matches what the owner is claiming that they pay. You don't want to have those disconnect. You don't want to make it like the owner look like they're saying one thing and the tenants think they're paying something else. Don't let your pride get in the way. If you discover irreparable issues, back out of the deal. You've also got the equity spread. Now, you need to understand how financing and equity play into the purchase to provide a buffer against market downswings. Do not over leverage by purchasing a property with no equity. Now, I have been guilty of buying some pretty high leverage property, but equity is the main buffer you have against a recession. So if the market drops 20%, but you had 30% equity in the property, you're still not even underwater. But if the market drops 20% and you only had 5% equity, you'll be underwater pretty quick. And until the property value increases or you pay off more of the house. Now, this doesn't really matter unless you sell while you're underwater, but it'll mess with your head and it's just not a safe way to buffer against losses. Also, the more equity you have in a property, the more cash flow it's probably bringing in because you probably owe less on it. Speaking of, cash flow is the money left over from your rental income after all, not just some, all of your expenses, including budgeting, have been taken out. Cash flow mitigates your downside risk because no matter what the market does, it's fairly easy to hold onto a property that is paying you to own it. If your property is struggling, simply reinvest this additional cash flow back into the property to help weather the storm. Now, to be clear, cash flow will not make your investment invincible, but it will definitely help. Cash flow also allows you to save more money for capital and cash reserves to help for when ish hits the fan. Next, you gotta have cash reserves. Cash reserves exist solely to protect your backside in the event of a downturn. Many investment banks require a certain amount of reserves to qualify for the loan. Now, I applied for a loan once and was informed that I needed to have enough cash reserves to cover all of the principal, interest, taxes, and insurance, payments for 6 months. I ended up not utilizing that bank, though I suppose that would ensure I was protected against downside risk at least, because that's a lot of cash reserves. A nice trick here is that the thrift savings plan, TSP, actually counts towards your cash reserves. That's one of the reasons why I love having my money in the TSP. My money is benefiting from compound interest, and while it is growing, I'm also able to utilize it as the cash reserves for banks when I'm purchasing a property. It's also there if I have to pull money out to make up for huge unexpected expenses. Now, I don't recommend ever dipping into your cash reserves unless you absolutely have to, but they're nice to have when Murphy's Law rears its ugly head. The everything that can go wrong does go wrong when the boss is around. And since you're the boss, you're around a lot. You also need to have exit strategies. Another great way to protect against disasters with your real estate investment is to have multiple exit strategies going into the purchase. Going into the purchase, you should be thinking through these strategies. Can you wholesale the property to another investor? Are you planning to fix and flip it? Maybe you can refinance it and hold it long term, which I may end up having to do with this property I was planning to flip. Or maybe you can even sell it with a lease option, rent to own, to one of your tenants. The point is that there are a lot of different ways to exit a real estate investment without losing your house, figuratively and literally losing your house. Plan ahead and always remember that it is the creative real estate investor who wins in the end. Now we're going to talk about protecting your risk, your downside risk in the stock market. As many of you know, I much prefer real estate investing over the stock market. One of the reasons is that I believe real estate has much better ways to protect you. Real estate investing is more tangible, so you can touch it, whatever, and less emotionally driven. So for example, Tesla lost something like 9% of its stock value when Elon Musk smoked a blunt on the Joe Rogan show. That is my least favorite aspect of investing in the stock market. Other people's emotions play into the valuation of my investments. When my real estate investments suck, at least it's my fault. So you need to focus on investing with logic over emotion. Now this is true in everything, but especially the stock market. The first way for you to protect yourself in the stock market is to invest logically rather than emotionally. Do not invest based on how you feel about the market. When the market drops, don't sell. When the market rises, don't buy. This style of investing is reactive in nature, and you're almost certainly too late. I know, but David, if I don't sell when the market is dropping, I will lose money. Yes and no. You won't lose a penny if you refuse to sell after the market drops, unless it goes to zero. If it comes back up, you will be right back where you started and on the rise again. Now, I know this is easier said than done because it's scary, but that is why you shouldn't listen to your emotions when investing. Also, if you are waiting until the market drops to protect yourself against it, you're too late. You don't know if it's going to drop 10% and then rise 20%. And if you sell in that scenario, you would lose money. Or perhaps it drops 10% more and then 10% more and then 40% more. But if you didn't sell when it comes back up, you're right back where you started. A method to mitigate your losses in a downturn is with a put option. Put options allow you to purchase the right to sell at a given price point, even if the market drops. For example, if I buy a put option to sell XYZ stock, if the price drops 10%, and then the market drops 40% in 4 days, I can execute my option and sell the stock at only a 10% loss. Put options are a great way to protect yourself against large losses, but they have a downside too. It costs money to buy put options. Let's say it costs 1% of the stock value to purchase a put option, and the stock does not drop within that window, and they have a shelf life. In that case, you're guaranteed to lose 1% of the cost of that put option. Is risking 1% worth avoiding a 40% drop? Sure, but how often does the market really drop 40%? And are you confident in your prediction abilities? What if you buy 10 put options and execute none of them? That's an automatic 10% hit to your portfolio, and it might erode any gain your portfolio experienced in this time. Put options are good, but they're definitely a more experienced investment strategies. Okay, so invest in the company and not the chart, not penny stocks. I know all the day traders are about to hate on this point. Look, I get it. Day trading is fun, sexy, it can be lucrative. Any good day trader will admit that they are investing based on what the charted daily market fluctuations look like and not the actual company. They are literally betting against the emotional buying and selling of other investors. Now, that's all well and good, but not how you want to invest in the long run. There are a lot of other reasons I'm not a fan of day trading, like time, tax implications, fees, lack of passivity, dividends, etc. But that's neither here nor there. The best way to buy individual stocks is to invest in companies that you believe to be future-proof. Companies like Amazon or Apple or Microsoft, Google, etc. will most likely be around for a long time. So logic says that as their companies grow, so will the value of their stocks. Therefore, they'll be much safer than investing in a company you don't know anything about that may or may not be able to withstand a recession. Now, dollar cost averaging is another great way to remove emotion from investments. Using this strategy, you invest $100 in the stock market month over month over month over month over month, no matter what the stock market does. That way, if the stock market drops, you're buying stocks at a lower price, but still $100 a month, and vice versa. By consistently investing and not reallocating your portfolio more than once or twice a year, you'll avoid making emotionally driven decisions. Index funds are a conglomerate of stocks, and this is another great way to invest long-term because you can purchase a total stock market index fund, and that means you're investing in the entire economy rather than just one company. In the long run, this is a good way to protect your downside and stay hands-off because I think the economy is going to do okay. I want to talk real briefly about protecting your downside risk as a mindset. Mindset is so critical to success in your life, and you need to adopt a mindset that is more worried about protecting your downside risk than it is about it gets excited about upside potential. Again, the name of the game is investing logically, not emotionally. Emotions are fickle and they'll get in your way. There is no easy way around this, so you need to protect yourself against emotional involvement as proactively as possible. I like to conduct a simple analysis of real estate investments before I even go look at pictures of the property. I guarantee there's almost no emotional attachment to the property. The last thing I want to do is begin daydreaming about what it could look like when I'm done renovating. The less you think about the property and the potential reward before analyzing, the better your analysis will be. In general, if you are feeling super excited, stop yourself and ask if it's interfering with the numbers. Remain as emotionally detached from your investments as possible. You hear me say it all the time, but never stop learning. The fastest way to hedge downside risk is to become an expert in your chosen asset class. And this goes for anything you do in life. The more educated you are about it, the better you'll perform. And that's why I suggest reading books, watching YouTube videos, listening to podcasts, paying for courses, hiring a coach, and becoming an expert in your field of choice. Side note there, mastermind groups are like a lot of those things all wrapped in together, and we have a phenomenal one called the War Room, and you should definitely check it out. So comment down below if you want some more information. Over the last 2 years, I have paid for books, courses, and coaching for writing, social media marketing, YouTube growth, podcasting, and of course, tons of other content on real estate investing and entrepreneurship. I practice what I preach here. If you're watching this, that's a testament. It is much easier to learn from those who have gone before you than it is to learn as you go. Trust me, I've done it all the hard way too many times. Also, trust but verify. Always verify what others are telling you about a potential deal. A prime example of this is a property I almost bought back in 2016. As we were negotiating the contract, the seller had informed me that the tenants paid the utilities. He stated they were around $400 a month for this duplex combined. When I pulled the utility report from the county, I realized that not only was the landlord paying the utilities, but it was closer to $600 a month for the duplex. Right there, I dodged a bullet. You see, the numbers on this property looked pretty good at first. But when I factored in the additional $600 a month for utilities, it no longer made sense. Now, sure, I could have instituted a ratio utility billing system, or RUBS, to combat this, but it would have been a much larger headache than anticipated, and that's really not traditionally done on just duplexes. So the moral of the story is always verify the seller was not misinformed or, let's be honest, lying to make the deal sound better. Now, you also need to trust your gut. Malcolm Gladwell wrote an incredible book titled Blink, The Power of Thinking Without Thinking, that is all about trusting your gut instincts. Did you know that within 5 minutes of talking to somebody, you can judge their character with up to 70% rate of accuracy? Not too shabby for 5 minutes. Of course, this is a little flawed sometimes. So he gives the example of your decisions. They may be biased based on how attractive that person is, their gender, etc. But you can train yourself to avoid these. It's a fascinating book, and it'll help you understand when and how to trust your gut with investing. I would say that more often than not, though, your gut instinct is right. I know for a fact that I could have avoided some growing pains if I'd trusted my gut more in some of my early investments. All right, all of this video can be boiled down to 3 simple concepts. Invest logically, not emotionally. Emotion does not belong in business. Be proactive, not reactive. Pay for insurance, have exit strategies, and plan ahead. And focus more on how to mitigate downside risk than how to increase upside potential when buying. I want to leave you with this awesome quote. As Warren Buffett once said, rule number 1, never lose money. Rule number 2, never forget rule number 1. Now get out there and don't lose money. Oh yeah, and make some money as well. Also, check out my video about house hacking if you haven't yet. That is a phenomenal way to protect your downside and to cut your savings and your expenses to really help build your portfolio. If you haven't looked into house hacking, you're looking into real estate, you've got to go watch that video or read the article. I'll post the link down below.